Hello and welcome to this discussion, brought to you by the team here at My Tax Accountant. Today we're diving into a question that, let's be honest, it's a pretty good problem to have for any UK business owner.
So you've done it. The hard work paid off, your business is in the black, you've actually made a decent profit. That is fantastic. But almost immediately, a new challenge pops up. What on earth do you do with that profit so you're not just handing a huge chunk of it straight over to HMRC?
Well, you're in exactly the right place, because over the next few minutes, we're going to walk you through the smartest, most effective, and, this is key, completely legal ways to invest those profits. The goal? To lower your tax bill and set your business up for even more success.
So, here's a quick look at what we'll be covering. First, we'll get to grips with the tax challenge itself. Then, we'll explore two main paths: investing profits outside your business and plowing them right back in. After that, we'll get strategic, before finally building a clear step-by-step plan you can start using.
Okay, first things first, let's just frame this whole problem. It's actually helpful to stop thinking of corporation tax as some kind of penalty. It's not. It's a direct result of your success. The more you make, the more you pay. The real trick is managing that profit smartly.
Right, so this is what it all boils down to. For the 2025-26 tax year, if your company makes up to £50,000 in profit, you're looking at a 19% tax rate. But once you get over $250,000, that rate jumps to 25%. Now, for profits that fall in between those two numbers, there's something called a marginal rate. Just think of it as a smooth incline, a sliding scale that takes you from 19% up to 25%. It's designed to stop you getting hit with a massive tax hike all at once. So our whole game plan is to find legal ways to reduce your taxable profit, which can actually lower your overall tax rate.
Okay, so how do we actually start chipping away at that taxable profit? Well, our first set of options involves taking any surplus cash your company has and putting it to work in investments that sit completely outside of your day-to-day business. These are often brilliant government-backed schemes designed for this exact reason.
Now look at that number, 30%. But here's the crucial thing to understand. This isn't about your business's tax bill. This is about your personal tax bill. This is the income tax relief from something called the Enterprise Investment Scheme, or EIS. So let's say you take some profit out of your business as a dividend. If you then take that personal cash and invest it in another small qualifying company, you get to slash your own personal income tax bill by 30% of whatever you invested. It's a fantastic way the government encourages us to back other growing UK businesses.
And honestly, the good news doesn't stop there. With EIS and a similar scheme called Venture Capital Trusts, or VCTs, any profit you make on that investment is completely free from capital gains tax as long as you hold it for a few years. VCTs can even pay you tax-free dividends. Now, these are higher-risk investments, so the government also gives you a bit of a safety net. If an investment goes south and you lose money, you can actually offset that loss against your income tax, which really helps to soften the blow.
Let's make this super clear with an example. Meet Sarah. She's a freelance designer in London, and her business is doing great. She decides to take a £10,000 dividend. She then invests that into an EIS-approved tech startup. Instantly, she can knock a cool £3,000 off her personal tax bill for that year. Fast forward a few years, that startup does brilliantly, and she sells her shares for £25,000. That entire £15,000 profit she made, it's completely tax-free. It's an incredible 1-2 punch of tax savings. Stay with me. The next point might surprise you.
Okay, so unlike EIS, which is all about your personal tax, pensions are a direct attack on your company's tax bill. This is, without a doubt, one of the most powerful and tax-efficient moves a business owner can make. When your company pays into your personal pension, that payment is treated as a legitimate business expense, just like a salary or office rent. This directly lowers your company's profit, which means a lower corporation tax bill, all while you're building up a nice pot for your retirement. It's a genuine win-win.
So let's just do a quick recap of those external options. You've got EIS, which gives you a massive 30% income tax relief, but it's high risk. Then there are VCTs, offering those lovely tax-free dividends at a medium risk level. And finally, pensions, a direct corporation tax saving for your business and very low risk. You can already see how mixing and matching these could be a really powerful part of your financial strategy.
Now, let's look at the next step. So far, we've talked about investing your profits outside the business. Now we're going to flip that and look at using them to make your own company bigger, better, and ultimately more profitable. And guess what? Doing this is also incredibly tax efficient.
This one is huge. The government's full expensing policy is basically a giant green light to invest in your own company's growth. When you buy qualifying new gear, we're talking computers, machinery, office furniture, vans, you name it, you can deduct 100% of the cost from your profits in the same year you buy it. So, spending £10,000 on new laptops for the team means you immediately reduce your taxable profit by that full £10,000. It's a fantastic way to upgrade your business and get your tax relief straight away.
And please don't hear R&D and think it's not for you. This isn't just for people in lab coats. If your business is creating a new piece of software, figuring out a more efficient process, or even just building a clever bit of code for your website, you could qualify. For smaller companies, this is a total game changer. It can mean deducting an extra 86% of your costs from your profit, on top of the original 100%. It's amazing.
And of course, there are plenty of other smart ways to reinvest. Every penny you spend on training your staff to make them better at what they do, that's a deductible expense. A big marketing push to build your brand? Deductible. Upgrading your software to make everyone more productive? You guessed it, deductible. Even giving to charity through your company can reduce your tax bill. All these things lower your profit while making your business stronger.
Right, we've covered a whole load of tactics, and this is really important, tactics without a solid strategy can sometimes do more harm than good. It's not just about chasing tax savings, it's about building a healthy, sustainable business. That's not all. Here's where most people go wrong.
This slide shows the two mindsets perfectly. You could have a short-term focus, chasing every tax relief possible, but that might lead you to, say, lock up all your spare cash in a high-risk investment, leaving you with no money for day-to-day needs. The smarter approach is a long-term one. You balance these great tax-saving tactics with the real-world needs of your business, making sure you've always got cash on hand and that your investments actually help you reach your goals.
And this is a brilliant way to see how that strategy changes over time. In year one, you might just be focused on paying your tax. But by year two, you're getting smarter, you're reinvesting in things like training. By year three, you're layering on more sophisticated things like pensions. And then you start looking ahead, maybe to an exit in year 5 or beyond. That's when you start planning for things like business asset disposal relief, or BAD, That's a relief that can let you pay just 10% capital gains tax on the first £1 million of profit when you sell your business. But you have to plan for it years in advance.
So, let's pull all of this together now. It's time to build a simple, clear, and actionable plan that you can start thinking about for your own business today.
Here it is, your 5-step roadmap. It's that simple. 1, define your goals. What do you actually want this money for? 2, give your tax situation a health check every year. 3, decide how to split your profits between running the business, reinvesting, and investing elsewhere. 4, pick the tax-saving schemes that best fit your goals. And 5, and honestly, this is the most important one, get professional advice.
Because that really is the most important takeaway from all of this. There is no magic, one-size-fits-all answer. The perfect plan for a startup in Manchester is going to be completely different from the right plan for a consultancy in London. So the big question you need to ask yourself is this: what is the right roadmap for your business?
And the good news is, you don't have to figure that out on your own. The absolute best way to build a strategy that's effective, that saves you money, and that's completely compliant is to work with experts who do this every single day. The team at My Tax Accountant can help you build that custom roadmap, one that's designed specifically for you. So if you're ready to really get in control of your business profits and build a smarter tax plan, you should get in touch. You can reach the team on WhatsApp or by phone on 07854 255 375, or you can drop an email to info@mytaxaccountant.co.uk. And for more tips just like this, make sure you hit that subscribe button. Thanks so much for your time.